You've put in the hours, you made smart financial decisions, you've maxed out your RRSP and your TFSA, and now, for the first time, you're sitting on a big non-registered portfolio. Money that you want to grow, but that's also sitting in the CRA's crosshairs. Here's the part that surprises a lot of people. Once your registered accounts are full, most of your investment growth from this point forward is fully exposed to tax every single year. Interest income, fully taxable. Foreign income, fully taxable. Even capital gains, they get taxed from the moment you sell or when the fund pays out a distribution. So what's the plan? Do you just keep investing the same way and hand over a chunk of your return every single April? Or is there a smarter way to structure your non-registered investments so that more of your money keeps working for you instead of going to Ottawa? This is where a little-known strategy comes in, one that very few Canadians are taking advantage of. It's called corporate class investing, and when you understand how it works, it can dramatically reduce the taxes you pay on your investments and help you build wealth much more efficiently. Hey there, I'm David Drummond, founding partner at DLD Financial Group. On this channel, I help Canadians retire confidently by building strategies that are simple, tax efficient, and designed to last. If that's important to you, make sure to like this video, leave a comment, and subscribe so you don't miss future videos. And if today's topic resonates with you, I'll leave a link in the description to book a call with me, because the cost of doing nothing, of leaving these accounts unstructured, can quietly add up to hundreds of thousands of dollars in unnecessary tax over your lifetime. Why corporate class funds matter. Let's step back a second and talk about why this structure even exists. When you hold investments in a traditional mutual fund or ETF in a non-registered account, here's what happens every single year. Any interest income earned by the fund is paid out to you, fully taxable at your top marginal rate. Foreign income from international holdings, same story, fully taxable. Even if you don't sell anything, capital gains inside the fund can get distributed to you. That means you could end up with a tax bill on gains you didn't choose to realize. So the government gets its cut every single year and you're left with less compounding power. This is the hidden drag on most non-registered portfolios. Now, here's what changes when you move those same investments into a corporate class structure. Number one, everything is taxed at the corporate level first. Instead of each fund being taxed individually, all funds inside the corporate class structure are pooled together and taxed as a single corporation. Number two, pooling creates efficiency. Losses and expenses from one part of the corporation can offset gains and income in another. This reduces the amount of taxable distributions that flow through to you personally. Number three, only tax-preferred income is distributed. So corporate class funds can only distribute Canadian dividends and capital gains, which are taxed at much lower rates than regular income. Interest and foreign income stay inside the corporate structure and can often be absorbed before ever hits your tax return. The result? You keep more of your money working for you and delay paying tax until you actually choose to sell. Think of it like this. If you were running a business and you could legally defer your taxes, smooth out your income, and only pay on the most tax-efficient parts of your earnings, would you take advantage of that? Corporate class funds give investors that same kind of control on their non-registered investments. And when you combine that with Tax-Smart CashFlow, a feature that lets you draw a stream of tax-efficient income from these funds, you've now got a way to turn your portfolio into a personal paycheck that doesn't punish you at tax time. This is why corporate class funds are so valuable. They give you structure, control, and tax efficiency at a stage in life where every percentage point matters. Tax benefit number one, minimize or defer tax. Traditional mutual funds often pay out interest income and foreign income, both of which are taxed at the highest rates. Corporate class, on the other hand, only distributes Canadian dividends and capital gains, which are taxed much more favorably. Interest and foreign income stays inside the corporate structure, where expenses can offset them. What does that mean for you? Fewer taxable distributions, more of your money staying invested and compounding. Think of it as tax deferral pay later, and let that money work for you in the meantime. Tax benefit number two, Tax-Smart CashFlow. If you're in retirement or just want cash flow, corporate class funds can be paired with something called Tax-Smart CashFlow, or T-Class. And here's how it works. Instead of selling investments terms on triggering capital gains, the fund pays you a return of your own capital each month. Since you've already paid tax on that money, these payments aren't taxed as income. This can help you reduce your taxable income, avoid or reduce old age security clawbacks, still keep your investments growing in the background when you've received all of your original capital back. Future payments become capital gains, which are still taxed at a much lower rate. Who can benefit most? There are three main groups who should consider this strategy. Number one is high net worth individuals. If you've maxed out your RRSPs and TFSA and still have a significant non-registered investment portfolio, corporate class funds can be a smart next step. Number two, retirees looking for steady tax efficient income, especially if you want to minimize OAS clawback while drawing a monthly cash flow. Number three, business owners with corporations. Corporate class funds can be even more powerful inside a corporate structure. They help fund a capital dividend account or CDA, which can allow you to pay yourself tax-free dividends from your corporation. And there's an added bonus for philanthropists. Corporate class funds can be combined with charitable giving strategies to donate more effectively and reduce taxes at the same time. A practical example: imagine you've got $1 million in a non-registered account. You want $50,000 per annum in cash flow. If that $50,000 came from interest income, you could easily lose over 50% to taxes in some provinces. But with a corporate class structure combined with Tax-Smart CashFlow, that same $50,000 could be drawn with an effective tax rate as low as 10% in the early years. A huge difference in what actually stays in your pocket. Why most investors overlook this? Corporate class funds have been around for decades, but they just aren't talked about as widely because they're more specialized. They work best when you've already maxed out your registered accounts and you need an advisor who knows how to use them properly. But for the right investor, they can be a game-changing tool to keep more of your returns compounding and less going to CRA. If you've built up significant non-registered savings or you have retained earnings in a corporation, this is where advanced planning can make a big difference. Don't just default to a standard investment account without thinking about taxes. The structure you choose can be just as important as the investment you hold. So here's the big takeaway. Corporate class funds are one of the most underused strategies in Canada for keeping more of your returns and creating tax efficient cash flow. If you want to explore whether this fits your plan, I'd be happy to help. Click the link in the description to book a time with me and we'll talk about how these strategies can work for you and your retirement. And don't forget to like this video, leave a comment, and subscribe if you found this helpful. Thanks again for watching. I'll see you in the next one.